Hi, I'm Jim Griffin, investment writer at Columbia Threadneedle Investments. Welcome to our retail column. When people invest in the stock market, they do so in the full knowledge that there are certain risks involved. But even the most experienced investor may have been surprised by the global volatility seen in early October that saw European stock markets falling to their lowest level in 20 months. The US Dow Jones Industrial Average Index also plummeted by more than 800 points, according to Bloomberg. With traders' screens turning red and the media writing doom-laden headlines about the state of the global economy, it was enough to test the nerve of even the hardiest investors. But what caused the stock market wobble? Well, investors have been increasingly worried by the US Federal Reserve raising interest rates, something that is historically bad news for equities. This is because when rates rise, money becomes more expensive to borrow, affecting everything from bank loans to mortgages and credit cards. This means consumers will likely have less money to spend, which can hit company revenues and profits. Businesses are also affected more directly because more expensive borrowing means companies are less able to expand their operations and generate greater revenues. In aggregate, this can affect entire economies, so it's no wonder stock markets react immediately to even a suggestion of rates rising. And if the US economy begins to stutter, it has huge implications for the rest of the world. So while the US has been performing strongly, fueled by tax cuts introduced by President Trump, there are fears that this boom is starting to introduce inflation and that the Fed will want to keep a lid on this by raising rates, hence the overreaction in markets. But is such volatility bad? The answer is that it shouldn't be, especially for long-term investors. The trick is not to panic, because what can feel like an emergency in the short term may not hold as much significance 10 years down the line. Indeed, long-term investing helps smooth out the peaks and troughs of the stock market and can be a more successful strategy than trying to time the market. There's more on this in the online version of this column. See you next time.